For 14 months, the Bitcoin ETF inflow streak held. Every week, more institutional money arrived. But that streak broke in April, and the market hardly noticed. The signal has changed, but the price has not collapsed. And that tells you something important about who is holding and why. This is the Bitcoin Weekly by Blockrise, recorded in Vienna this time. And here's what actually matters. Bitcoin is trading around $77,000, or roughly 66,000 euros. This week has been flat, down 0.02%, so the volatility has quieted, but the range has not narrowed. Bitcoin is trading essentially at its 50-day moving average, less than 0.5% above it. It remains about 4% below the 200-day moving average though. The short-term picture is constructive, but the bigger reclaim is still in progress. What is notable is the volume profile. When the ETF inflow streak broke, the price held. And that is not a sign of weakness. That is a sign of who is still in the market and why they are staying. Here's what actually happened. The US Bitcoin ETF product suite saw its first continuous outflow streak in April. Not one bad week, but a pattern. The largest product recorded multiple weeks of net outflows. Most headlines treated it as a warning, but I think that conclusion was wrong. And here's why. ETF products are like a wrapper product. They serve a specific function in the adoption curve. They bridge traditional capital into Bitcoin for investors who are not ready to self-custody yet. And that is a legitimate role, but it's also a transitional role. When an ETF sees outflow, two things can be happening. Either institutional holders are selling Bitcoin, which would be quite bearish, or ETF shareholders are redeeming shares to take direct position of Bitcoin, which would be the most bullish thing imaginable. The data point towards the second explanation is coming up. The wallets receiving those Bitcoin transfers look like cold storage setups, long horizon holders, and that is not panic selling. That is investors doing exactly what the ETF was designed to eventually enable, moving from the wrapper to the actual asset. Michael Saylor said it plainly. Strategy did not sell Bitcoin to fund operations. It sold preferred equity, structured debt, and used the balance sheet more efficiently. At the same time, Strategy added around 535 Bitcoin in the same period it was managing a $2 billion debt raise. The real signal is not that the ETF inflow stalled. The real signal is that investors who used ETF wrappers are graduating. And they are actually taking possession of their Bitcoin. Because if you cannot really verify a Bitcoin, is it really there? ETF outflows in this environment look less like distribution and more like verification. So this ETF story got quite some attention, but this corporate treasury did not, in my opinion. In the past 60 days, at least 7 public listed companies added Bitcoin to their balance sheets through structured treasury programs. And there were not so many announcement tweets about this. No speculative press releases, actual purchases documented on public. Some of these companies are not in the Bitcoin sector. They are in logistics, manufacturing, and professional services. They're using the same playbook Strategy pioneered. Preferred equity raises, convertible notes, structured debt. Ways to acquire Bitcoin without selling equity at distressed prices. And this is quietly the most significant institutional adoption of this cycle. It's not a few companies following Michael Saylor. It is mainstream corporate finance discovering Bitcoin as treasury reserve asset. The difference about this cycle in 2021 is that companies are not borrowing to buy Bitcoin. They're issuing structured capital to buy Bitcoin, which was unheard of back in the days. The balance sheet is managed, the trades are deliberate, the horizon is very long. And most market commentary missed this because it does not move the price in the short term, but it's moving the narrative. Bitcoin as corporate treasury asset is not a niche idea anymore. It is a playbook being copied across sectors and across jurisdictions. What makes this more durable is the structure. Not leverage, not hype, capital market engineering that works with the cycle, not against it. Then, 2 things to watch for the next 2 weeks. First, whether Bitcoin reclaims the 200-day moving average with conviction. The distance is now roughly 4%, and that level of resistance has been there for months. Reclaiming it cleanly changes the technical picture from recovery to structural turn. It also changed the narrative from frame Bitcoin bounced to Bitcoin is in a new phase. And second, whether the corporate treasury accumulation story gains a second wave of coverage. Right now it's sitting below the ETF noise. And if a major mainstream outlet runs a structure piece on corporate Bitcoin treasuries, the audience that might miss it the first time will catch up fast. This is not financial advice, it's just my perspective on what's happening based on building 10 years in this space. Do your own research, don't forget to like and subscribe. See you in 2 weeks and verify your Bitcoin.